3 stocks that I personally own. Remember, guys, don't buy any stock because anybody on YouTube says it. We're here to teach a process. And the 3 stocks I own, first one, Rowe Price. Guys, I want to own a lot more Rowe. I'm down 7.57%. The reason I bring that up is it does not faze me. In fact, one of the next 2 stocks I have, I'm up significantly on, and it actually annoys me. So let's go check out Rowe Price. Mo, you do not own Rowe Price.
Do not. Something I'd be interested in, though.
Yes. So let's see here. Rowe Prizzle.
Asset managers.
They manage money. They're at $98 right now. So here are a couple of things I like about Rowe Price. 1, market cap of $22 billion, enterprise value of 21.8, which means they have more cash on hand than debt.
You don't see that often.
You don't see that often. And guys, it's very hard. Think about your personal life. If you had more cash in your bank account than you had all your debts, mortgage, credit cards, car loans, how hard would it be for you to go under? You're going to last a long time. All right. Another thing I like for a lot of people, but first off, valuations. 13.6 PE, 10 on the 5-year PE. And the price of free cash flow is down a lot because their free cash from last year is significantly lower than net income. But everybody likes this dividend.
You like it?
What was that?
Do you like it?
Mo, it's time for them to start buying back some shares. Yeah. This is a very unpopular opinion. Save this $1 billion and buy back some shares. Every year, you'd be reducing the share count by about 4 or 5%. I'd much rather have them. Imagine the next 10 years that every year they're buying back at $10 billion. They'd be buying back half the company. Mm-hmm. And now I would own twice as much a percentage of the company than I do today.
Especially at these valuations.
And I fully expect this will fall precipitously as the market falls. These guys are asset managers. Yeah. They manage money. If they get fee generation on that money, what's going to happen to the revenue and profit? It's going to decline, right? Mm-hmm. Rowe Price had a high on August 30th, 2021 of 206, a low of $87 just a few weeks ago. Yeah. Okay, so that's something to consider here. Now, let's go to the 8 pillars.
Okay.
All right, net income and free cash flow. Like I said, market was down last year. Where was their revenue and profit?
Down.
Right, while their cash flow net income was. Right?
Yep. It's going to probably decline more as well.
Yes.
If the markets fall and people get scared, they withdraw their money, et cetera.
Yeah. So it's kind of an interesting bet. I'm making a bet on a company that I also think the market's overvalued. And as it declines, the market's, the stock of it is going to go down. Yeah. Okay. How much is it going to decline? I don't know.
Who knows?
But I'm fully comfortable buying it as it goes to $40, $50 a share. I don't care. Maybe even lower. That's the point I'm trying to reiterate here. All right, so Rowe Price, let's pull it up. Let's look at the analyst estimates. Now, analyst estimates, look at this. They're looking at flat EPS for the next 4 or 5 years. Mm-hmm. Okay, revenue, actually down on revenue.
Yeah. So I wonder if they're baking in rough times for the next 5 years.
Maybe they are, maybe they're not. I don't know. So I have it on my watch list at $85. Let's just pull up the last time I did this in our stock analyzer tool. And the great thing is I can pull up our history. June 28th. I did a 10-year analysis, 0, 3, and 6%. I did profit margin much lower than they've done in the last 5 to 10 years. I did 24, 28, and 32 when their profit margin in the last 5 and 10 years has been this high. But I think the reason I did that was look at their free cash flow. Mm-hmm. Okay. PE, I did 15, 17, and 19. My desired return, I did 9, 11, and 13. All right. And what's my values? All right. Great. Now, I went a little bit lower. I should actually increase my desired annual return to factor in no growth in the market. Let's do 11, 13, and 15. All right. So I should actually put it on my watch list for higher than 80. I think I know I did 85 because it fell below. Yeah, well, it also did. So I'm going to change my watch list here.
So I don't know when the last time you did this. I did this on the 24th of October, and that was 3 days before their 52-week low. So,
all right, stock number 2, Disney. I'm up 12.37% on Disney. And the other day we were making a video, and I was like, "Where the hell did Disney go?" I'm absolutely upset that Disney is up. I'm absolutely upset, and I'm going to dollar cost average as it goes down. And let's take a look at Disney and see why I am bullish on Disney, guys. The reason I own Disney is I look at the profit margin, 2.6%. I look at this and think to myself, that can't be good enough. Let's look at their before COVID numbers. They did $65 billion in revenue in the year ending June 2019, and their profit was 12.32. That's almost 20% profit margin. The previous year, over 20%. The year before that, 15%. The year before that, 15%. Do you see my point here?
They got screwed with the shutdowns and shutting down their, not only parks, but cruises, et cetera.
Yeah, so I'm looking at this going, guys, this is I hope this is a short-term profit margin collapse. And once the profit margin, and there's a lot of people out there who say, Paul, the profit margin is never going to get back to normal. Okay. I've heard this 1,000 times, and it's Disney. Maybe it won't.
How do you feel about the market cap to enterprise value? It's different from what you usually see.
If this were, so it's 174 versus 255, a lot of debt. If this weren't Disney, I'd be a lot more concerned than Disney itself.
Yep.
Right. And plus, the other thing is, what are their parks on the book for?
Yeah.
Like I look at that going, if they want to sell all their parks and everything like that, well, how much money would they get?
Right.
Look at the assets they have and that have nothing to do. So that's not even included in that enterprise. I look at it going, I'm okay with this. All right. Very low return. This is purely because look at the 8 pillars here, Mo. Look at this.
Bad, aren't they? If I remember.
Oh, one green check.
Terrible.
And this is exactly what I say. The 8 pillars aren't a buy or don't buy method. It's a way of telling a story. How could a company like Disney have so many X's? That's the reason why it intrigued me. And when I saw the profit margin being so much lower than history, I'm like, okay, I'm making a bet on Disney itself.
It amazes. I mean, I know 3 people. Well, I guess Dalton's not going anywhere. 3 people that were supposed to go to are actually going when I'm supposed to go to Disney this weekend, after Thanksgiving. It's crazy.
Yeah.
I mean,
they're sociopaths.
Like my lawyer, he's like, we go to Disney every single year on Thanksgiving.
Mikey has the Disney like presidential club membership that Dad got him for his wedding present. My brother literally asked for the before he had kids, because he loves Disney so much. They go every year.
My lawyer goes 26 times a year.
Wait, what?
26 times a year. They go 26 times a year to Disney.
Every other week?
Yep. Every other week.
They live in Orlando.
They live in Tampa. They just drive to Orlando. Isn't that crazy?
Man. Okay.
Man is right. Every other week.
Third stock, 3M. I'm down 1.8% again. To repeat over and over, I expect to be down more, and I will dollar cost average as it goes down. If you can't do that, stick to ETFs, guys. Buying stocks. I wrote on Twitter yesterday. I said Warren Buffett and Charlie Munger always say that when they're looking for privately held businesses, ones that don't have stock, it's hard to get a really good deal because even in bad times, privately selling businesses sell for the same multiples. That's the key of understanding that publicly held companies will sell for ridiculous prices high and ridiculous prices low, and you got to be ready for that. And you've got to be okay that when you see a stock. So I'm down 1.8% on 3M, which means my cost basis is roughly, what is that? $97, $98, all-time high of 210 back in January of 2018, over almost 6 years ago now. Okay. Big dividend yield, 6.3%, eats up a big chunk.
Huge.
And Mo, why are you shaking your head?
What are they doing?
Guys, stop this. The price to free cash flow is 11. The 5 years 9.8.
I completely understand why they're not reducing that dividend because there's been a lot of bad news for the stock. The price has been abused. They don't want to abuse it anymore, I'm sure, but that's just stupid for the long-term outlook.
Cut the dividend, get everybody pissed. The stock falls 30% and you buy back even cheaper shares.
And you are a hero in 10 years.
And you're a hero in 10 years. You just got to go through some short-term pain.
But you're already in short-term pain, so just keep going.
Right, well, even more short-term pain.
Throw it on the fire.
Let's go look at our last time I did 3M.
Wow. Analysts actually have growth
October
here.
9th.
Interesting.
I did 1, 3, and 5% revenue growth, 10, 12.5, 15 profit margin, 12, 14, 16. This is a rare company where the free cash flow is higher than the profit. We love that. Okay. PE of 15, 17, 19. I mean, look at my price here. And this is when the stock fell. So I changed that watch list price. I got to change this back. I'm going to add this back to, let's go to 92.5.
It's an interesting one for sure.
Actually, I'll put 90.
All of these are really not turnaround plays. That's the wrong word for it, but you got to be patient and hope profit margins come back.
Yeah. That's just the way it is.
Well, not really
except for TROW, not for TROW.
TROW, you just have to be comfortable losing money in recession.
Guys, if you like this community, like the software, really quick, check out everythingmoney.com. We have a 7-day free trial. Go check it out. You won't regret it. You'll get the full community with 1,000 investors. We're talking about all 3 of these stocks. Thank you very much for your time.